Today I'm going to show how volatility tends to spike near the bottom of the market, or when the market's bottoming. I've got a good chart for that. We're going to talk about the presidential cycle a little bit. We're going to look at seasonality of the first year of a presidential year and look at how that, and it's actually playing out pretty close, pretty spot on to where I would expect it to. We're going to look at current money flow stuff that I normally show every month, where we're at, where it's kind of moderate, where I think it could turn. And then finally, there's a fun one, the Kitchen Cycle. I was on the David Keller podcast, Market Misbehavior, earlier this week, and we talked about that. The Fed interest is going to meet next week, and I don't think they're likely to lower interest rates, but they probably should by a quarter point. That's just, I don't have a chart on that, but I thought that was an interesting point, looking at data and where they should be, and they're probably a little bit behind again. But the odds are not favoring them doing anything. So I'm kind of curious what their forward thinking is, but they're probably getting back to being behind. So let's dive in. So yeah, this week I was on the David Keller Market Misbehavior podcast. A lot of the stuff I'm going to talk about today, we talked in more in depth than I have time to here. So if you want to go check that out, we talked for about 20 minutes on really just the cycles and things like that, as well as the exposure index by the National Association of Active Investment Managers. So it's a cool podcast. It was a lot of fun. Dave's an awesome guy, really smart technician. So it was a good conversation. So do check that out. All right, let's talk about volatility. So we're looking at volatility spikes. When the volatility, that's the fear index for some. It's 30-day expected volatility of the S&P specifically. And then there's also the whole thing we can get into about what the futures are versus that, and are they higher in the future or lower. Currently, all the fear is right now. There's really not a whole lot of fear in 60, 90 days plus from where we are right now. So that's something to keep in mind, because that means that the fear is now and it's not later. So as the market peaks and they have these great shoot ups on the VIX, that's usually around the bottom, even when they're not that big. I mean, this is what, 22, 24 is where we are now. We were up a little bit higher than that. And that's probably meaning we're getting washed out, right? These spikes tend to correspond with bottoms. So that very likely could have been, unless we get another spike today, but the market's just kind of chopping sideways. We're up a little, down a little, and up a little, down a little means like 1%, because volatility is higher. It's kind of crazy. We get these, the morning might be up 1%, and then we're down 1% at the end of the day, or vice versa. We've had days where we start off -1 and now we're +1 by the end. It's just higher volatility market is not necessarily bad, because if that calms down, that's typically going to match up with a reversal period. So let's look at seasonality for the first year of a presidential election, of the presidential cycle. So look at this. February was expected to be down. How about that? From really the middle of the month until about here. Wait, isn't that about where we are right now? I think in the first week of, or second week of March, maybe we should see a relief rally. Maybe it stays choppy for this next little bit, but this was completely expected. It's within the norm. I think it was a little bit bigger than we would have expected or even liked. But nonetheless, this is exactly how things played out, as we talked about last month before it happened. And I can show you in the cycles and the rotation graphs that this was expected. And now this is going to chop around a little bit, and we're probably going to get a good run through April and even May. And then after that, we get into that sell in May period, and then it's going to be interesting again. And I think the real ugliness is going to happen in 2026 for a lot of reasons. A couple months ago, I did the bear case, or the bear market buzzkill case. That's a good webinar, and I go through a lot of reasons why I think it's really going to push out over there. And I'm actually even going to add one at the end of this presentation as to why, another factor showing how that's going to play out also. So looking at the S&P, I normally don't show it, but I thought this was too interesting. This is the S&P 500 over the past about 4 or 5 years, about 4 years. And now, but down here we have the 14-period RSI, which is the relative strength index, and that's just kind of showing kind of a buyers and sellers. Is it getting extreme in either case? And I've got little green arrows right here and here and here and here, and right now showing when it drops below this 30 line, and that typically will correspond with maybe a short-term bottom. Like it was back in here, we did get a rally from it, or a longer term, you got a couple here, and then we did finally pull out of that pretty well. So we're seeing that same kind of extreme fear that corresponds with bottoms. We're also seeing that I don't have it. The CNN fear and greed index is pegged over on the fear side. So that's, as Warren Buffett says, you be greedy when others are fearful, and we are very much in that environment. It's just all fear. So and there's not a whole lot of bad data just yet. I think inflation came out actually a little bit better this week, so that's not a problem. Certainly, tariffs are an issue. I think those will resolve, but that could take time, and I get that. But beyond that, we're not seeing a whole lot of problem yet. Not even in unemployment's not even spiking as we would have liked, not like to have seen, but that would correspond with this kind of market. So we're not getting the factors that make me, totally in agreement that this is the right thing to be happening. Now, I think it will in the next 6 months, 12 months, next year. Yes, I think it is, but I don't know if this is the start of it. And that's going to be another thing to be watching for. Can this revert and hit new highs? We were hitting new highs 3 weeks ago, and that's wild. Because usually when you get a new highs and then you get a pullback, it's pretty rare that that's just it. Usually you'll get a retest back up to those highs, and if it can't get up there again, then that's like where you start to say, okay, now we really need to be fully on the defense. Much like over here. So you had a new highs, you came back, and then right here was like, okay, it's just not going to run anymore, and that's time to something's going to be wrong on a bigger scale. So keeping that in mind. So money flow, yeah, it did go negative. It's not really that bad. It really isn't. Back here it was worse, and the market really didn't seem to care when the money was coming out. Now the market's caring a lot, but the money flow is not there. And that kind of goes back to sentiment things as well. We talked about it on David Keller's show, is that the AAII, the individual investors sentiment scale, is like off the charts, like as bad as it was at the worst part of 2022. I think 3 years ago when we had a pretty ugly year. The sentiment is as bad as it was at the worst point of that time. And we're really not in that same situation. Because then you compare it to the name sentiment index, which is the National Association of Active Investment Managers, which is like comparing those two as like the professional versus the amateur, not positive or negative, but the name index is fairly positive. There's not a whole lot of fear in that one. So it's interesting to watch the contrast of people who watch this stuff daily, who are thinking about the trends, are really not seeing a problem yet, where the individuals are doing more of a panic thing here. And I think panic is something that you look at buying into, at least in the short term. I don't think long term is going to be good, but that's for a later time, right? That's not where we are now. Money flow is kind of slowly dripping out. It's not real exciting. It's not straight off like it was back here. But what I'm also looking for now is if we get one of these green dots, we get enough volume pushing back into the market, it's probably going to be a really good time to buy. I just don't know when that is. I think today is still just kind of grinding sideways, but at some point you get a big thrust, and that should be the start of a next little run up, and we're very close to that. But we have to wait for that. That's the hard part. The waiting is the hardest part. So we'll see where that happens. And the rotation, I think, will give some hints as that as well. So current sectors, we are at one positive, which is consumer staples, which is the defensive sector. Although the big defensives, I believe, are the staples, healthcare, and real estate can be. Those tend to be the safer assets. They're all over here, but they're also the weakest ones in the rotation graph, which I'm going to hit next. Whereas we have the typical market leaders like technology, communications, consumer discretionary, which is things like Amazon and Tesla, actually, have gotten so beaten up, they're probably primed for a good run off of this. Here we got those XLV is healthcare, real estate, consumer discretionary, consumer staples. These are the safety assets, right? Those are kind of coming out of leading and into weakening. Now, way over here, we have, this is technology. Here's communications, financials, and consumer discretionary, right? At the Amazons and those, right? When these start turning up, that's going to usually lead the market pretty quickly in an upward direction. We're just hanging out here. So that's, watching the ducks go around the pond, they go clockwise. So at some point, they're going to make a turn and shoot up into this improving box. And that's usually when things are getting really good and you want to be part of it. We're kind of just in a mess, but this is what happens. This is the setup before we get that shift in sentiment. And I think it's all setting up nicely. I mean, I love seeing these all push up together, and you get a very big, broad movement. So this is the setup here. In February, they were all up here starting to point down. And I had said then, it looks like weakness is gonna come in soon, even though we were hitting new highs and we did for another week. And then it eventually did push. So, these things do continually rotate around the pond as the ducks do. So we're setting up for the next little push. I don't know when it's going to be. You kind of have to wait and watch for these guys to start pointing upward. But that's what would come next. And to finally, I was going to show you the 181-week Kitchin Cycle. This is it's basically the inventory cycle. And I got this from my friend Jim Lee, who's a big cycles guy. There's actually an association for the study of cycles where he got this, and it kind of shows that it's a 3 to 5 year inventory cycle. So when I was thinking COVID and toilet paper, right? And there was a point where there was a huge demand and not enough supply. And then I'm sure as time went on, they ended up having they made enough, and but no one needed it anymore. So now there's an over thing of supply. There's too much there, then that price could go down at that point. So it kind of thinks in those terms. So this is pretty good at calling when the cycles are going to be strong up in the market and when they're going to be iffy. Right here, market's going down. Right here, it's up and then down. But so it's sketchy in that part, but tends to correspond with market tops. And this, it's really hard to tell, but the actual peak is a little bit further out week wise. So it's probably not until that May or June. So if you think back to that seasonality chart, that we could have a good April, and then into May is then where this really is where that starts to turn down and is ugly until really the end of 2026. And there's the case for it right there. That tends to be ugly times when that cycle is falling. Doesn't have to be, nothing has to happen, but I think that's what I'm looking forward in the future.